Welcome back to this tutorial, and this is another example of effective interest rate amortization of bonds, and we're going to do bond amortization using straight line depreciation and also bond amortization using effective interest rate. So what's different from this? What's different in this example is that this bond is trading at a discount. You can and in this our bond was trading at a premium. I'll show you how. So this ABC company has 5-year 9% $100,000 bond issued at a 10% market rate of interest. Our market is demanding 10% rate, but our coupon is paying only 9. That means we have to reduce our price. We're only paying 9%, but market wants 10%. What that means is we have to lower the price. Anytime uh, this 9% is what we're offering, but the market wants 10%. The only way we can sell this bond is if we price it cheap. If you have a product that's priced cheap, people will buy it. So how do you calculate the present value of the bond? This is actually we issue this bond, so at time zero or presently we will receive present value of this bond. Rate is, we use market rate, which is 5% because it's semi-annual compounding. It's 10%, so semi-annual is 5%. Number of periods is 10 because 5 years, 5 times 2, 10. The payment, so the coupon is 9%, so we have 4.5, so our payment is 4,500, and at the end we have to pay back our face value, which is the future value, 100, 1, 2, 300,000, and let's see, yes, we have this. Let's make it positive. Let me just format this a little bit. Okay. So what's our coupon payment? It's 4,500. Drag it. Okay. Now this is the key step where a lot of people go wrong, and because we're carrying some value, because we have some payables. I mean, this is the amount we owe. We loaned it from somebody. We loaned it from the investors. So anytime we, like I said in the previous video, I mean, watch the previous video. Anytime we issue, we have to pay interest because this is on our balance sheet. We're carrying this amount. We're carrying this amount. This is book value, so we have to pay an interest on that. So what's going to be that interest? That interest is simply this, the carrying value times times the market rate of interest, which is 5%. Okay, so this is our interest, which is 4,806 and 96 cents. Now the key step where most accounting students, finance students, and go wrong or don't understand is this step. So pay a lot of attention. So our coupon payment, which we are paying to investors every month, is every year is 4,500, but the effective cost is 4,806. So we are paying less. So what's that amount that we are paying less? What's the shortage? This minus this. So you're paying 306 less. So what happens if we owe this? So you got to pay. This gets added to your book value. This gets added to your book value. So now you see this is increasing. We'll see that. Why is it increasing? Because you haven't paid this. You still owe this. You owe them this amount. So the next year, in year two, we have 4,500 coupon. Our interest payment's gonna be this, the carrying value from the previous year times, you got to use, anytime somebody loans you money, they're not going to give you for free. You have to pay an interest on that. So what's the interest? Market rate of interest. Okay, and so 4,500 is our coupon payment, but our effective interest payment, which goes on the which goes as an expense on the income statement, is 4,822. So you're only paying 4,500. So we subtract this, we are short of this. We haven't paid this. We haven't paid this amount, so we add it back to this previous book value. Now, now we owe now we owe interest on this amount. So if you repeat this process, you're going to have something like this. You see over here. So um, what? Sorry. So what has happened here is we borrowed 96,139, and at the end of year 10, we have to pay $100,000. Okay. So the our interest cost is $100,000 minus this. This amount right here, let me highlight this in red. Okay, and let me, this amount is really, this is our interest cost. This amount right here was our interest cost. How did we get that? We got this if we we got this because we borrowed 96,100. This is the cash we received from our investors. Okay, and we paid them and we paid them 100,000. So what's the implied interest rate? So how much was the interest that we paid? So our interest cost is this. So what the effective interest rate method is saying is that you distribute this cost evenly. You distribute this cost evenly. In year one, you'll report in your income statement as an expense. Okay, so you distribute this evenly. So let's see what happens if you add this. You see this number in red? That's what this entire video series is about. You distributed this interest, okay? This is what the whole series is about. This has to be equal to this. This illustration is is not explaining you what's happening more about bonds. You have to go read the book. This is just explaining how these things are recorded in the financial statements, how auditors, transact these statements, how they bill. Like at the end of year 10, you pay this, and this goes off the book value because you have retired this debt. So at this 96,000 was your debt at the beginning, and at the year one, this is your debt. This is your debt. Okay, so you retire this debt, and this is your interest expenses that goes on the income statement. Thank you for watching this tutorial.